With the merger between Standard Life and Aberdeen now formalised, international investment caught up with MyFolio multi-manager head Bambos Hamby and fund manager Joe Wiggins to speak about future plans for the range.
How long have you been looking at launching something that could be invested in internationally, and was the timing right?
I think it'd been under discussion for a significant amount of time. We just wanted to make sure that we got the proposition in its correct shape and we had all the component pieces that we needed to put it together. It's difficult to judge what the perfect timing might be for any product, but what we wanted to do was to build a track record with the CCAV structure, with the global orientations to asset allocation. So there was no particular reason for the December launch, except for we had the portfolio in the shape that we wanted, and then we could start building the brand and building the portfolio's track record through time. What we think we have is a diversified portfolio in the CCAV across 16 asset classes, across different managers, so broad diversification, investing for the long term. So the exact starting point wasn't as important to us as getting the portfolio in the correct shape for the initial investors.
On the timing side, one of the key successes for us here in the UK has been we did a lot of work before we launched MyFolio, and a catalyst at the time was the retail distribution review. So what does retail distribution review mean for the UK financial market? And what we are seeing is that Holland's now adopted the retail distribution review, and it looks like it's going to be accepted more across Europe and then potentially the world. So central investment propositions, we are used very much as a central investment proposition by many financial advisors out there. The banning of commissions, that's been very central. Advisors charging fees, having to segment their client base. So what do they do with their small clients? They need a solution for small clients because they can't afford to they don't get commissions any longer, etc. So a number of factors came together. But the other thing about the success of MyFolio here in the UK, which should be able to be replicated around the world if we can get the structure right, is that when we launched MyFolio, before we launched it, we did quite a lot of research with advisors and customers. The advisors and customers were both telling us that the problem they had was the difficulty of choice. Number one, what asset classes do you go to? In MyFolio here in the UK, we use 19 asset classes. In the CCAV, it's roughly the same. So the difficulty of choice at asset class level, but then once you've decided on your asset classes, what funds do you invest in? We have a universe of 18,000 odd funds. So clients are facing that prospect, advisors are facing that prospect of where do they go?
So CCAV has even more though, I presume.
Say again?
The CCAV has
so,
even more.
So got a wider universe.
In terms of the available funds?
Yeah,
I think marginally, although increasingly what we can invest in the CCAV we can invest in the UK, there are some exceptions to that. But there's the universe for both vehicles is incredibly broad, and investors inevitably suffer with a paradox of choice where there's just so many options it becomes quite difficult to understand what that correct choice is. So we think MyFolio can help with that challenge.
And the other side of it was the customer was telling us that during the credit crisis they weren't happy in that asset managers would do well on the way up, but they weren't very good at protecting on the downside. So across our active range, we include absolute return in two ways. So we include absolute return as a defensive asset class. We use absolute return bond funds, looking for cash plus 2-3% with very low volatility. And then as a growth asset class, we use absolute return multi-asset, the best known fund being SLI GARS. We use that as a growth asset, looking for cash plus 5 equity type returns with a third to half the volatility. So that was on the back of feedback from customers, and that's worked really well for us during the volatile periods we've had when Europe looked like it was imploding, when the euro looked like it was going to be disbanded back in summer of 2014, summer of 2015. Those shock absorbers came in and did really well for us. and we've got many happy clients on the back of a 6-year track record now of smoothing returns using 19 asset classes, but very importantly using the right absolute return vehicles as the shock absorbers during the times you want them.
And I think being transparent about the level of risk we want to take for each portfolio really helps clients to understand what we're trying to do and to frame expectations correctly. We're not trying to chase peer group averages around with the portfolio allocations. We have a volatility target, and we're trying to create the most efficient portfolio to meet that volatility target over the long term. So that transparency is really important for both us and our relationship with clients.
Now, do you have, when you're looking at selecting managers, and I would liken this to a football team and their transfer targets. Do you have, how big are the filters? I mean, obviously you start with 18,500 or whatever it is, and then everything filters down. Do you have a top 100 or a top 200 or a top 400? How does that work?
We have various means of cutting the universe down. Initially, the obvious filters are, is it the right asset class? Does it match the asset class constraints that we have in MyFolio, which will narrow the universe? And is it investable to us for a variety of reasons? We do employ a quantitative screen as well, which looks at both risk and reward through the cycle and over the long term. And that's more to get an understanding of the typical outcomes of a fund and the potential behaviours of a fund, rather than simply is performance good or bad, is risk good or bad. We don't think, we're aware that quant screens have limitations in what they can tell you, but that's one way we can kind of slice and dice the universe to focus our attentions on the right areas. And also we've become quite nuanced in how we might target particular funds. So we have a meeting called a portfolio strategy group, where the portfolio managers from the team and the analysts sit down and cover a particular asset class. So let's say, for example, US equities. We'll talk about the environment for US equities, how we're positioned from a style perspective, where we might want to be positioned going forward. So we might have a discussion and decide actually values underperformed for 3 or 4 years. It's looking relatively attractive from a pricing standpoint. Do we have enough value in the portfolios? And then we'll talk to the analyst about the value options that they have, and then they'll be able to use various tools, be it something like Morningstar or Star Research or Bloomberg, to filter that universe down to funds that might meet the criteria of what we're looking for in the portfolio. So we can be quite targeted about how we approach fund selection and get that universe down and focus on the right areas, so our shortlists meet the requirements of the portfolio managers.
And when you talk about smoothing, it almost sounds like this is quite a nice alternative to with profits, which was very much, the Standard Life way back in the day. Would you agree with that?
It has been described as a more transparent with profit type of service. I mean, we're using probably more asset classes than I would say the traditional with profit funds we're using. We use a lot of short duration bonds, which act very differently to your conventional bond market. We're using absolute return managers, which I don't believe the with profit funds used to use particularly. So I would say we're a much more sophisticated and much more transparent version of the with profit funds as something that people may be aware of historically.
And I think it's important to say we are across the range from risk level 1 to risk level 5 invested in risky assets to a greater or lesser extent. We're not immune to the vacillations of markets, and we don't pretend to be immune to that. What we want to do is create a diversified structure, so there is insulation from those difficult periods, and that diversification comes at asset class level because of the number of asset classes we use, because of the absolute return exposure, and because of the managers we use as well. We use managers with different styles who perform in different market environments. So we're certainly not guaranteed, and we're certainly not immune to market movements, but we're trying to create a structure that gives a more balanced outcome over the long term.
Looking back to the past, we used to focus on the fund managers, the stars, and manager moves was incredibly important to a fund-of-fund multi-manager approach. Finding out who's retiring first, getting in and out of funds at the right time. Is that still, how important is that still to what you do?
Yeah, it's still very important. We still view new funds alongside the 5 Ps that you may recall we've been using for a few decades now.
Yeah.
And people is the 4th P. And it's great if you can find a team. It does away with key manager risk, and it's something we've tried to do here. So something we should touch on later is the number of people involved with MyFolio, which is we've got over 60 people involved on the investment side of MyFolio, and I'll take you through that later. But in terms of answering your question, probably the biggest cause of our turnover is manager moves. Quite often it is an individual that you've highlighted is the key difference. It's that extra skill that you require, it's that differentiator in a fund. So we do spend a lot of time understanding who are the decision makers, how they work, is there a team, but very importantly, if there is a team, who are the vital people in that team?
Yeah, and I think before we invest in a fund, when we sit down and discuss the due diligence, we will always ask the question, if a certain person would depart, what do we expect our action would be? So therefore we're explicitly addressing the question ex ante, who are the important people and what action will we take if there's a significant change there. So we have some funds in the portfolio, they're very team orientated, so one individual departure might not be as important, whereas we have a number of others where the loss of a key individual would inevitably lead to us moving on.
Let me give you an example as well. So we had money with the American team at Threadneedle, a team of 8.
Yeah.
And a lot of the 8 we'd met over a number of years, and we were very comfortable. There was a lot of quality there. 7 of the 8 all resigned at the same time to go and join Artemis. So one left behind. So what we did was we met the lady left behind who was going to manage the new team, and they had Columbia in America with a big bank of analysts, so she was trying to persuade us that there would be no change. Obviously that wasn't our impression. So we moved all the money into a tracker. They turned up at Artemis, launched a new fund 6 months later. We moved all our tracker money and seeded a brand new fund. This is a team that was 7. The philosophy hadn't changed, the process hadn't changed. The people were still there. We obviously used past performance at their previous shop to understand what we were expecting going forward. And when you see the brand new fund, you lock into a fantastic price as well. So it met a lot of our requirements, and in year 1 they underperformed the S&P 500 by about 5%, where a small pot of assets, hungry team, put a lot of their own money into the portfolio themselves, and it worked a treat for us, and it continues to be in the portfolios 3 years later, and it's working really well. And they've just had another fantastic 12-month period, very pleased with that. And we've seeded about a dozen new funds over the last 3 years. So we are keen on seeding new vehicles. It tends to be in areas where we're finding a lack of coverage. So short duration corporate bonds has been a key area for us, because that was a big asset class for us. There weren't many, when we first moved into asset class, there were only 1 or 2 funds available. We've seeded 3 or 4 actually in that space now.
I'm an investor. Why would I want an SLI stroke Aberdeen fund of funds when I can have the whole universe?
Believe it or not, most of the flows that we've had have been in our managed product, which is predominantly SLI investments. Big part of that is people like active management, but it's a medium lower cost option than the multi-manager. By having an internal fund of funds, fettered, also known as fettered, the costs are reduced for investors.
Yeah. So you don't have that double charge necessarily.
There is an extra layer fee, but it's a lot lower.
Yeah. Looking globally, Standard Life Investments and Standard Life have operations across the world, but adding or growing that bit bigger by joining forces with Aberdeen, it makes you a larger group, but it also opens up those new outposts, given the for example Asia.
Absolutely.
So that must be a real bonus for yourself and for the CCAV range.
Yes, particularly exciting for the CCAV, given, as Bamble said, the complement to the nature of the regional exposures of both companies, and you mentioned the Asian presence that Aberdeen have, so that's exciting for the CCAP, and clearly we've got a global proposition here, so that if we can broaden our distribution, that makes it even more attractive.